slide. Great, thank you. So today, I said welcome everybody to our latest webinar, which will be going to look at both exploration and the energy transition in the UK and Norway. On the call today, I've got myself, Emma Cruickshank, who's the head of Northwest Europe research here at Westwood, manage the Atlas product. I'll be joined today by Alyson Harding, who's a technical manager within the Northwest Europe team, and Stuart Leitch, who is our new energies research manager, covering everything from emissions through to CCS, hydrogen and offshore wind. So just what we're going to run through today is Ali's going to kick us off with a 10-year look at exploration activity and performance, covering some key themes around basin and company performance and company strategies. She will also cover the latest oil and gas licensing rounds, as well as an outlook for exploration in 2023. Stuart will then look at the energy transition in the region, covering emissions performance and decarbonisation of the oil and gas sector, CCS including progress of the UK's first licensing round, as well as a look at hydrogen activity in the region. I should say that if you have any questions throughout the presentation, please use the Q&A session box within Zoom. We'll answer some as we go, and we'll save some up for the Q&A session at the end. So if we just briefly look at introducing who Westwood Global Energy is, for those that don't know, we provide subscription-based data services, bespoke reporting and commercial advice to clients in upstream operations, onshore and offshore energy services. Our suite of products are shown here on the right, and all the data and analysis you will see today largely comes from the top 3 products of Atlas, which covers Northwest Europe EMP, Wildcat, that looks at global exploration, and New Energies, which is an integrated product that is part of Atlas, covering CCS, hydrogen, and offshore wind. If you're interested to find out any more about Westwood services, then please do get in touch. So just to set the scene before I hand over to Ali, I'm just going to set the scene with sort of looking at the energy trilemma. So over the last few years, the energy industry has had to adapt to the changing priorities within this energy trilemma. In 2020 and 2021, the focus was on environmental sustainability in a world that assumed affordable and reliable energy was not a pressing issue. When Russia invaded Ukraine in early 2022, oil and gas prices spiked, and energy security became a major concern for countries in Northern Europe. Throughout 2022, as prices soared, with rising energy bills and inflation, and supply chain costs increased. This led to the affordability vector of the trilemma being front of mind for governments. However, by the end of 2022 and into 2023, we are now seeing more of a balance between the 3 vectors. Although there is much uncertainty for the industry going forwards, there is a wider recognition among policymakers of the role that oil and gas production, and hence exploration, needs to play in the transition to a net zero economy. So I'm now going to hand over to Ali, who's going to look at the exploration activity and performance in the UK and Norway.
Thanks a lot, Emma. Could you go to the next slide, please, Gareth? Okay, many of you will have seen slides similar to this in previous talks. They look at exploration activity and performance in the last decade up to the end of 2022 and in the UK and Norway. The map in the middle shows the exploration well density for that period based on well programmes. And as you can see from the map, the main basins have had the most activity, with the more frontier areas shown by only a few scattered wells, such as areas of the southern North Sea, west of Shetland, and parts of the Barents Sea. The graphs show the number of exploration wells drilled per year, colour-coded by basin, and exploration drilling spend on the second y-axis. Exploration activity over the last decade has been impacted by 2 major oil price crashes and a global pandemic. These have resulted in large fluctuations in drilling costs, exploration activity, and therefore discovered volumes. It'll be no surprise to most that the number of wells drilled in the UK continues to decrease, with 2019 being a bit of an outlier in the last 5 years. Only 5 wells completed in 2022. Norway has been less impacted by oil price, and COVID has seen an uptick in exploration since 2018. Over the decade, Norway has had almost 3 times as much drilling, delivering well over 3 times as many discoveries at over half the drilling finding cost of the UK. And whilst commercial success rates are broadly similar at 20% and 25%, discovery sizes reflect the fact that the UK has more mature basins than Norway. Can you go to the next one, please? Looking at exploration performance, the graphs show the number of wells drilled per year, colour-coded by whether they were a dry hole, non-commercial or commercial discovery, with a line showing the commercial and technical success rates. In the UK, the average commercial success rate was 20% and only dropped below this in 2013 and 2019. Since 2019, however, only 4 or 5 wells have completed each year, and the statistics are therefore not representative. In Norway, success rates have been above 30% in the last 3 years, an increase on the rest of the decade other than 2016 when the commercial success rate was 41%. Next slide, please. Looking at performance in terms of discovered resources, the graphs are showing total resource from commercial discoveries each year and the drilling finding costs per barrel of oil discovered. Drilling finding costs are much higher in the UK, averaging $13.8 a barrel compared to $5 a barrel in Norway. In the last decade to 2022, the UK has failed to add any large discoveries, with none greater than 40 million barrels of oil equivalent. Appraisal wells on Glendronach, which was discovered in 2018, Glengorm in 2019, and Isabella in 2020 have all been downgraded from initial discovered resources of over 100 million barrels to less than 50 million barrels each. The recent Pensacola well in the southern North Sea, which is not in these statistics, has bucked the trend, finding about 50 million barrels equivalent, but this needs to be appraised. Prior to 2014, Norway was adding about 500 million barrels or more per annum of commercial resources. For much of the decade, volumes have been significantly lower, with the exception of 2021, when discovered resources returned to over 500 million barrels equivalent, with several discoveries close to 100 million barrels each. All require appraisal, so the resource number might change. 2022, however, was a disappointing year, with only about 200 million barrels discovered. Next one, please. Focusing just on the UK for this one slide, the NSTA published a report called Overview 2023 on the 7th of February, which detailed exploration success rates and volumes since 2014. And I would like to explain why Westwood presents statistics that are different to those of the NSTA. The graph on the left shows the well count that the NSTA presented, plotted against the number that Westwood hold. The well count for the NSTA historically included sidetracks, re-spuds and re-entries as individual wells, hence the large numbers in 2014 to 15. This is believed to have now changed for recent years. It also counted wells against the spud date, but then changed to the completion date. The right-hand chart plots the NSTA technical resources against Westwood's commercial resources in dark green and non-commercial in light green. The table stated that statistics are calculated on the year of completion, and note that the NSTA data was only up to 2021. The NSTA do not downgrade discoveries once they've been appraised. Westwood, on the other hand, will take the latest published or estimated resources for a discovery. So the larger discrepancies in recent years will be Glendronach in 2018, Glengorm in 2019, and Isabella in 2020. It should be said, though, that the NSTA has access to a lot more information than we do, such as resource sizes and actual well costs. Next one, please, Gareth. I'm now going to focus on some exploration themes, firstly looking at basin performance. The top graphs show well count per basin coloured by discovery type, i.e. commercial, non-commercial or dry, along with commercial and technical success rates. The bottom graphs show discovered resources by basin, split into oil and gas phase, with dots showing drilling finding costs. The Northern North Sea had the highest commercial success rate, and the West of Shetland had the lowest, with the exception of the East Irish Sea. Although the Central North Sea was the most explored basin with 57 wells, it only achieved 16% commercial success rate in the UK. Drilling in the Southern North Sea has been a low priority in the last decade, with only 13 wells. However, we are starting to see a pickup in activity, with the Pensacola well completed earlier this year, and the Erne and Kellam wells are expected to spud this year. All commercial discoveries in all basins were ILX, except for Verbier in the Central North Sea. In Norway, the Northern North Sea was the top performing basin in terms of commercial success rate and the most discovered volumes at almost 1.1 billion barrels equivalent. The Norwegian Sea has the second highest commercial success rate and discovered volumes. Success in both these areas came almost entirely through ILX wells. Only Buster in the North Sea was not ILX. The Central North Sea had the equal lowest commercial success rate and found relatively low volumes in the 8 discoveries, so has a high finding cost. The Central North Sea is the poorest performing of all the basins in Norway. The Barents Sea has a low commercial success rate of 15%, with only 9 commercial discoveries. However, the basin discovered material commercial volumes of 737 million barrels at the lowest finding cost compared to other basins. The dominance of oil for commercial discoveries in the Barents Sea is due to the lack of offtake routes for gas discoveries. Therefore, they are deemed non-commercial. 22 technical discoveries were made, but often stranded because of this. However, almost all the commercial resources were discovered in the first part of the decade. Next one, please. Over the next few slides, I'm going to look at company analysis and exploration strategies, starting with the UK. The left-hand graph shows the number of gross explorations drilled by each company in the last 5 years, only plotting those companies that drilled 2 or more wells. The right-hand graph has net discovered resources. The maximum number of wells drilled per company is 6. 4 companies, which were Apache, Shell, Spirit, and Equinor, drilled this number of wells. Eni and Total Energies drilled 4 or 5 wells. Only 14 companies made commercial discoveries, many at high finding costs. 4 of these only drilled 1 well. On the next slides, I'm going to go into more detail about a few companies, but standout companies include Apache, who discovered the most resources. Ithaca and Chrysaor had the highest commercial success rate at 67%, but both only drilled 3 wells. So the next slide, please. Oh, you're there. These 100% bar charts show the relative percentage of various data series on illustrating the different strategies taken by companies, for example, whether it is an operator or non-operator, which basins were explored, whether ILX dominates drilling, and how much risk appetite there is for high impact drilling. This is the same 19 companies as in the previous slide, which are those that drilled 2 or more wells in the last 5 years. I will discuss a few of the companies in the next slides. The next one, please. Apache has drilled 6 exploration wells, all have been operated and all have been ILX wells, with 4 in the Northern North Sea and 2 in the Central North Sea. 3 of the wells were successful, all of which were ILX wells around its Beryl hub. Next one, please. Although perceived by many as a company that had stopped exploring, Shell has drilled 6 wells, with 4 of these in 2022. The wells were a mix of ILX and high impact wells across all basins, although most were in the Central North Sea. Only 1 commercial discovery was made at Rockhopper, a small ILX well as part of the Penguins redevelopment in the Northern North Sea. Shell has completed 2 wells to date in 2023, though, both of which made discoveries, which is Pensacola and Orlov, and is currently appraising the Cruickshank discovery in the Southern North Sea. Next, please. Harbour Energy has only drilled 2 exploration wells since the merger of Premier in 2021, both J-Block ILX wells in the Central North Sea. Jade South made a commercial discovery which was rapidly tied in to existing production facilities on the Jade field, while Dunnottar made a non-commercial discovery. Prior to the merger, Chrysaor drilled 3 wells, of which all were Beryl ILX area wells in the northern North Sea, and 2 of those made commercial discoveries. Next, please. Now turning to Norway, and note that the scales are different. Also, the companies that have been named have drilled 5 or more wells in the last 5 years, rather than the 2 wells for the UK. Equinor clearly stands out as they drill the most wells, followed by Petoro, although the combined numbers for Aker BP and Lundin would have been the highest. Commercial success rates vary widely, from 56% for Neptune down to 0%. Other successful companies in terms of commercial success rate are Vår Energy and Wintershall Dea. Next one, please. Looking at the 100% bar charts for the 22 companies that drilled the 5 wells or more in the last 5 years, it is clear that the ILX wells are more prevalent in Norway than in the UK. Again, I will discuss a few of the companies in the next slides. So thank you, Gareth. Equinor has been the most active explorer in Norway with 73 wells. It has a relatively diverse exploration portfolio, drilling a mix of ILX and high impact wells across all basins. It has operated about 70% of its wells and has been the most active in the North Sea. It has performed relatively well in all performance metrics, particularly in the North Sea, around its core hubs. It participated in 20 commercial discoveries with net discovered volumes of 325 million barrels. All but 2 of the discoveries were operated, and all but 1 was ILX. The Northern North Sea was the best performing basin with a 37% commercial success rate and 185 million barrels equivalent net. Next one, please. Aker BP has been one of the most active explorers. It has participated in 46 wells with a balance of near field, high impact and frontier wells across all basins. 67% of its wells were ILX, with a focus around its operated hubs of Alfheim in the North Sea and Skarv in the Norwegian Sea. It only participated in 11 commercial discoveries, with net discovered volumes of 117 million barrels equivalent. The Norwegian Sea was the best performing basin with 50% commercial success rate and 70 million barrels equivalent. It is looking to fast track development of a number of its discoveries. Most of these are small incremental tiebacks to existing infrastructure. Next one, please. Neptune Energy has only been an active explorer on the NCS since 2019, but ranks highest in terms of commercial success rate at 56%, having participated in 9 commercial discoveries with total net discovered volumes of 65 million barrels. 75% of wells were drilled in the North Sea, with the remainder in the Norwegian Sea. All but 1 was ILX, focused around a number of hubs including Troll, Snorre, Gjøa and Brage in the North Sea, all targeting mature plays, except for 2 wells around the Gjøa hub that targeted emerging plays. The only high impact / frontier well was at Silfari in the Norwegian Sea. Next one, please. Wellesley Petroleum has been one of the most active explorers in Norway, which has led to the rapid growth of its portfolio. It has participated in 21 wells, of which 76% were in the North Sea, with the remainder in the Norwegian Sea. The majority were ILX wells focused in mature plays around the Gjøa and Troll hubs in the North Sea. It has participated in 5 commercial discoveries, with net discovered resources of 56 million barrels equivalent. Its success has come from advancing discoveries to the development stage, then monetizing them, having secured deals with PGNiG and Equinor. There appears to be no single exploration strategy in either the UK or Norway that stands out as being the most successful, although in both countries, most success has come from ILX drilling around operated hubs. Next one, please. I'm now turning to the perennial issue of overestimating resources pre-drill. These plots show pre-drill versus post-drill commercial and non-commercial resources for wells from the last decade and 2023 year to date, where both pre and post well volumes have been released by the operator or a joint venture partner. The high impact and outliers have been labelled on the UK chart. Melvick and Warwick Deep are off the scale pre-drill. Post-drill, they were non-commercial at less than 10 million barrels equivalent each. The UK plot shows that mid-case pre-drill resources were consistently overestimated. Note, however, that the Pensacola P50 pre- and post-drill resources are similar. In Norway, the graph is harder to label with high impact wells as there are too many, so just more recent wells have been labelled. Norway has underestimated pre-drill resources in a few cases, Bergnat being one that stands out, and this discovery is being appraised in Q3 this year. The story remains that companies consistently overestimate resources prior to drilling, although in Norway some wells have bucked that trend, such as Bergnat, and others that have discovered more than expected for mid-case resources are all less than 70 million barrels equivalent. These include Pill, which is now Fenja, Iris Hades, Kara, which is now Duva, and Orn. Next one, please. And I'm now going to look at the outlook for exploration for 2023. And the graph is an exceedance curve with commercial discoveries in green and non-commercial discoveries in orange for wells that have been drilled in the last 10 years, plotted against resources discovered on the x-axis. The pre-drill resource estimates for 2023 wells are plotted as green dots if already drilled, or red dots if drilling or planned. The associated box shows the P10, P50, P90 resources calculated from the exceedance curve. In Norway, there are 37 exploration wells expected to be operating in 2023, targeting pre-drill resources of 1.9 billion barrels equivalent. 11 have completed. For the 3 that are active and 2 still to 24 still to spud, total pre-drill resources are 1.5 billion barrels equivalent. 4 discoveries have been made at Obelix Upflank, Rover Soar, Heisenberg and Vey, with a total of 130 million barrels equivalent. A further 3 discoveries have been made that Westwood have assigned as non-commercial. 6 of the prospects yet to spud have less than a 10% probability of exceedance, and 19 have 50% probability of exceedance. Equinor, as expected, has the most planned wells that have not yet spudded, followed by Aker BP, Vår Energy and DNO. Of note is that although many companies are now shunning the Barents Sea, Vår Energy still has the area as part of its strategy, having drilled a non-commercial discovery at Kantash this year and planning to drill Venus later this year. High impact wells to watch are the OMV-operated Veloceti well in the northern North Sea and Vår Energy's Venus well, already mentioned in the Barents Sea. Move on to the next one. In the UK, there are 12 exploration wells potentially expected to be operating in 2023, targeting pre-drill resources of about 1 billion barrels equivalent, the largest prospect being Devil's Hole Horst with 580 million barrels. This number was updated at BEOS a couple of weeks ago. Prior to that, it was 990 million barrels, but they have had a new CPR done, which reduced the resource, but increased the chance of success. 3 wells have completed to date, and commercial discoveries have been made at Orlov and Pensacola, with a non-commercial discovery at North Egg. The Orlov well tested at 5,230 barrels oil per day and 16.2 million standard cubic feet a day, but no resource figures have been published, so Westwood is holding an estimate of 25 million barrels equivalent for that well. Pensacola tested after acidization at a maximum rate of 4.75 million standard cubic feet a day, but this declined after a 12-hour test to 1.75 million standard cubic feet a day. The drop can be attributed to formation damage in the well, as that would have been drilled overbalanced. Resources of 300 BCF were quoted by Deltic. 5 of the prospects drilled or yet to complete have less than a 10% probability of exceedance, and 7 have a 50% probability of exceedance. There have been no wells drilling in the west of Shetlands since 4 wells were drilled in 2019, but currently there are 2 wells drilling at the BP-operated Ben Lawes, where Shell have recently farmed in, and the Total Energies-operated Ben Riach. It would be excellent to have some success with these. Next one, please. APA 2023 opened on Wednesday, with applications to be submitted by the 23rd of August. This is earlier than historical timelines, which have mainly had application deadlines in September, and may be a challenge for companies juggling summer holidays and getting approvals for applications and work programs during that time period. The area expanded by 92 blocks in the Norwegian Sea and Barents Sea, and these are shown by the brown colours in the 2 right-hand maps. The 14 blocks in the north are in the northwest of the Norwegian Sea, and they're in the Fenrisgraben and on the Voring Marginal High. Next one, please. At the annual Barents Sea conference held in Hammerfest on the 26th of April, the NPD Director General Torgeir Stordal called for more exploration to be carried out in the Barents area. In his address, he outlined that only 6% of resources have been produced in the Barents Sea to date, and the region is estimated to hold about 64% of Norway's undiscovered resources. The lack of gas infrastructure has been the sticking point, but this is being investigated, and Gasco published a report on the 17th of April looking at gas transport from the southern Barents Sea. Of the new blocks, 78 are in the west of the Barents Sea, in the Bjørnøya Basin, Sør-Vest-Naget Basin, with a few blocks on the Vestbakken Volcanic Province, on the Stappen High, and in the Finger-Djupet Subbasin. It'll be interesting to see how much interest there is in the Barents Sea, as many companies have publicly pulled away from the basin, and others are only focusing on ILX in the region. In the APA 2022 awards, only 2 Vår Energy operated licenses were awarded. One was close to the Snøhvit hub, and the other in the far eastern part of the Barents Sea, with blocks on the Nordkapp Basin, Thor Inverson Fault Complex, and Finnmark Platform. Next one, please. Looking forward to future exploration, the long-awaited UK 33rd licensing round was eventually announced on in October 2022, 3 years after the last round closed. This followed the climate compatibility checkpoint approval on the 22nd of September last year. It was not, however, without drama. The Energy Profits Levy, introduced on the 26th of May last year and amended on the 17th of November, led to several companies reviewing their UKCS investment. In particular, Harbour Energy chose not to apply in the round, which had a knock-on effect on its joint venture partners. At the time, the 22nd round was considered to be a last chance and also had a high number of applications. In that round, the awards came in September 2020, when the world was gripped with COVID, commodity prices are dropped and budgets slashed. This led to 15 of the offered licenses being rejected. It's worth noting that the NSTA count all applicants, even if they are subsidiaries of another applicant. The NSTA had indicated that gas opportunities were a priority, and 4 key cluster areas were identified in the southern North Sea. Historically, a large number of firm well commitments would have been made in licensing rounds, as shown in the graph, for the 25th to 27th rounds held between 2008 and 2012. However, since the 2014 oil price crash and the introduction of the Innovate licenses in 2016, there's been a reduction in firm and contingent drilling commitments. Since the 28th round, commitments have dropped off dramatically, with only 13 firm wells committed to in the last 4 rounds. There have been very few wells drilled on recently awarded licenses. On 30th round licenses, 7 exploration and 6 appraisal wells have been drilled. There have been no E&A wells drilled on the 31st or 32nd round awards. However, Westwood does hold some planned wells on more recent licenses, such as the 30th round Greenwell, Kellam, K2, Isolde, Skerryvore and Selene prospects, plus the 32nd round Erne and Dabinet. There will be likely more that Westwood are not aware of. Next one, please. The two maps show Westwood's view of undeveloped discoveries and prospects in blocks available in the round. The left-hand map shows undeveloped discoveries, which is greater than 5 million barrels equivalent, with the circles coloured based on hydrocarbon phase and the size of the circle reflected of the resource size. On the left are prospects, again greater than 5 million barrels, that have been mapped since 2020, coloured by phase but not sized. The graph on the left shows the number of undeveloped discoveries on offer in each basin, colour-coded by what age the discoveries are. Westwood hold 143 undeveloped discoveries in the available blocks, with about 2.5 billion barrels equivalent technical resources distributed across all basins. By play, the Jurassic and Tertiary accounts for 64% of the discovered resource, mainly in the central North Sea and northern North Sea. The southern North Sea, as you would expect, is dominated by Permian and Carboniferous and is almost entirely gas. Prospects have been captured from many sources, including farm-out conferences, relinquishment reports, intelligence from companies, and other published material. Westwood holds prospects with unrisked prospective resources of about 41 billion barrels equivalent. It is highly likely that the applications are focused on prospects and discoveries adjacent to current production, as companies seek to maximise value and prolong the life of existing assets. An increase in appetite for gas opportunities is also expected. There is still an appetite in both the UK and Norway for exploration and licence rounds, with some areas expected to be contested based on feedback from companies. Oil and gas is still needed into the future. However, companies will be faced with an additional challenge associated with achieving net zero emissions, including increasingly stringent environmental regulations. There'll be a continued focus on reducing time to monetize discoveries and minimize operational emissions. I'll now hand over to Stuart.
Thanks, Ali. Can you hear me okay? Excellent. So I'm going to have a look at some of the energy transition themes we are seeing in Northwest Europe. So pulling it back to the presentation title, the role of exploration in the energy transition, we're reminded of that slide at the beginning on the energy trilemma. In 2022, and even earlier, it was all about sustainability. Many governments were setting net zero targets in law. Discussions focused on how do you decarbonise the oil and gas industry. Ambitious Scope 1 and 2 emissions targets were set. Electrification of offshore assets was a hot topic. We saw a number of oil and gas companies entering the ET space, be that offshore wind and blue hydrogen. An interest in CCS, while it's been around for a number of years, suddenly ramped up. It was accepted by some that ET was becoming a license to operate. Step forward 2 years, and we've got all those factors still on the sustainability side. But as you've touched on, Ali, we now have the drive for increased production and energy security. So how do you achieve both? Now, I'm not going to try and cover everything today. We'll be here till next Tuesday. But I'm going to take us through some of the key themes and select items. So looking at the emissions performance of the offshore oil and gas sector, and are we maintaining those downward trends? On the offshore wind sector, how is the offshore wind industry helping support the decarbonisation of the oil and gas sector? On CCS, I'm going to look at the storage potential around Northwest Europe, and then the progress of the UK's first carbon storage licensing round. Well, on hydrogen, I'm going to look at the differences in how the industries are developing in UK and Norway. So let's start on that emissions performance for the offshore sector. Now, this is a busy slide, so I'll walk you through it. At the top, we see the emissions performance of the oil and gas sector at a country level. Total emissions are shown in black in million tonnes of CO2, while the blue lines show the emissions intensity of the region in kilograms of CO2 per BOE, so a measure of performance. I should state the 2022 numbers for the UK are forecast based on Westwood's estimated values, while the Norwegian values are based on the 2022's actuals released by EU ETS. So in the UK, we have seen a reduction in absolute emissions over the years, going from 13 million tonnes in 2018 to 10 million tonnes in 2021. However, a review of the emissions intensity, where you see the decline is not as great, suggests that that's partly due to reduced production and hub closures. Westwood expects absolute emissions to remain relatively constant in 2022 as the focus shifts towards increased production. The bubble plot below shows an individual hub performance for 2022, so each bubble being an individual hub. you'll see a large variation in emissions performance on a hub-by-hub basis, with many hubs operating well in excess of the regional average. But despite the reduction in absolute emissions being partly driven by hub closures, if you were to delve into each of these hubs and look back on a number of years, we have seen some success stories in the UK, with some of the hubs managing improvements with minimal capex spend. The challenge will now be, can we continue that downward trend on absolute emissions as the low-hanging fruit has been plucked and increased capex is needed for further decarbonisation efforts. Jumping over to Norway, you can see the country has maintained its downward trend in absolute emissions, helped in part by a number of the electrified platforms. The bubble plot below shows the status of the platforms as they were in 2022, with the purple dots showing the emissions performance of the partially and fully electrified platforms. In fact, in 2022, nearly 20% of the production came from electrified platforms, with many of these facilities producing at less than 1 kilogram of CO2 per BOE. When you consider that the hubs in yellow all have firm plans for electrification in the near future, Norway's performance is only going to continue that downward trend in future years. Now, the easy approach when you review this slide will be to say, okay, let's just electrify the UK. But we all know, and it's been well documented, the challenges the UK industry has with powering the UK directly from shore. And I don't plan to go over all ground. What I would like to do is look at how the UK is looking to the offshore wind industry for support in this area. Electrification of oil and gas assets directly from offshore wind is still a relatively novel concept. You've got Hywind Tampen in Norway, a floating offshore wind farm, which will partially electrify the Snorre and Gullfaks platforms. But other than that, the uptake is slow. With power to shore proving to be an expensive solution in the UK, the UK has tried an alternative approach to accelerate the integration of the offshore wind industry with oil and gas, with the introduction of the INTOG round last year. So INTOG being innovation in targeted oil and gas. So focusing on the TOG part of that, the integration of the oil and gas industry. In principle, it's a relatively simple process. Your wind farm will supply power to neighbouring oil and gas assets, while also sending power to shore. There's no absolute size on the TOG project, but there's a proportionality principle to ensure that there's sufficient focus on the decarbonisation in project planning. A developer can bid for no more than 5 times the demand it intends to supply to the oil and gas operators, and for a minimum of a 5-year demand. In 2022, Westwood held 40 operating oil and gas hubs in the UK. So on initial inspection, TOG part presents a significant opportunity. However, we need to consider some of the metrics that make an oil and gas asset suitable candidate, be that platform COP dates, the power demand, and proximity, to name but a few. So prior to the results being announced at the end of last year, Westwood completed an analysis of the TOG areas available and found that actually of those 40 operating oil and gas hubs, only 14 were viable candidates for the TOG round at Westwood's base case price assumptions. Suddenly that TOG opportunity may not be as large as initially thought. And we saw this when the results were announced in March. In total, there were 9 TOG areas which companies could apply for acreage on of any size, and yet many of these did not achieve any successful awards. All successful TOG awards came within 2 of the available areas, both of which are shown on the map here on the left. The additional acreage, which was further north, both to the east and the west of the Shetlands, did not receive any successful applications. Of the 5.4 gigawatts of total capacity awarded as part of INTOG, the TOG part accounted for 4.9 gigawatts, which was split across 8 projects, with the most valuable lease in the TOG section being Flotation Energy's Area 6, which in the cost per megawatt was nearly 50% higher than any other TOG lease. As Area 6 is located nearby Buzzard, probably one of the longest lasting hubs in the central North Sea, we now start to understand why. So INTOG's still pretty early on its journey, but we look forward to monitoring how it progresses. Now, while the focus of this slide has been on the UK, we should note the recent announcements over in Norway for their first offshore wind auction for the Storlige Nord's Phase 1 and the Utsira Nord areas that were announced in March this year. The application deadline is at the end of Q3. Both rounds expected to be awarded by the end of 2023. Now, moving over into CCS around Northwest Europe. So in the IEA's net zero by 2050 scenario, 1.6 gigatons per annum of CO2 is captured by 2030, raising to 7.6 gigatons per annum by 2050. Not small numbers. Here in Europe, Europe boasts an estimated 500 gigatons of theoretical storage capacity, with over 150 gigatons being located in the North and Barents Sea. UK and Norway holds the majority of this, with Denmark not far behind. Now, there's plenty of different CCS forecasts and assessments on storage potential in different regions, but all agree on one thing: there's a lot of CCS needed, and we have a lot of potential in Northwest Europe. So here we show a regional overview of carbon storage. The map shows an overview of the areas of carbon storage potential by basin, color-coded by whether the reservoir is an aquifer or a depleted field, and also showing the ages and formation of the potential sinks. Working my way clockwise, most of you will know the Northern Lights project in Norway. Injection of CO2 will be into a lower Triassic aquifer and could be online in late 2025. In the Norwegian-Danish basin, the Greensands project is a tertiary sink at the depleted Nini West oil field and has already been given the go-ahead for a time-limited injection period and has successfully injected CO2 into the reservoir. In the southern North Sea, the Northern Endurance project is targeting a Triassic Bunter Formation sandstone sink, while the Viking CCS project nearby is targeting a depleted field with a sink in the Permian-Rotliegend group. In the East Irish Sea, the HyNet project has a Triassic Sherwood sandstone group reservoir and is planning to inject into the depleted hydrocarbon fields. The Acorn project in the Moray Firth of Scotland is also well publicised, with potential sinks in the Golden Line depleted Lower Cretaceous Captain Member Reservoir and aquifers of the same age in the area. In the Barents Sea, the Polaris CO2 storage project is targeting CO2 storage in saline aquifers. So, huge amount of potential in both depleted hydrocarbon fields and saline aquifers. So we've looked at the potential. I'm now going to jump into a bit of a deep dive on the recent UK's CS licensing round. We had hoped to be able to share with you the results of this round, which were due to be announced in Q1 this year. However, we're still waiting to hear on this. So instead, I'm going to do a bit of a recap of the round itself and look at some of the areas that were on offer. I know there are some strong rumours this week that announcement may even be ready by the end of the week, but let's watch this space. Once those awards are announced, Westwood will produce a full analytical report, which will be available. So prior to the award, there were 7 carbon storage licenses that have previously been awarded over the last 10 years in the UK, of which 6 are currently active, and all of these were awarded out of round. Then, towards the middle of last year, the UK carbon storage round was announced in June and closed on the 13th of September. There were 13 areas offered based on pre-round nominations, 8 in the southern North Sea, 2 in the central North Sea, 2 in the northern North Sea, and 1 in the East Irish Sea. The map on the right here shows offshore licenses at the time of announcement in yellow, and the areas offered outlined in purple. While we don't know exactly who bid, we know there were 26 bids from 19 companies received across all 13 areas. If we jump to the next slide, I'm going to jump into that round in a little bit more detail. So the chart on the left here lists the areas, the size of the areas, and what percentage of the total that represents. You can see the areas available were dominated by the southern North Sea with 73% of the acreage offered. Over on the right, we've configured the map slightly differently to better understand these areas available. As before, areas offered are shown in pink, but this time we show the existing carbon storage licenses in yellow and their associated CCS projects. We also show the CO2 emission sources from large emitters shown in the brown bubble plots. Relative CO2 is associated with the size of those. So one can see from the maps, some of these areas that were available for in the round are directly adjacent to existing carbon storage projects, while others were a bit more removed. And as we said, while we don't know the results, we do not expect too many surprises, with bidders expected to be looking at opportunities to repurpose existing assets while leveraging subsurface knowledge from areas they know best. From public announcements, we know Inquest applied for 2 licenses in the east of Shetland. Neptune submitted 3 applications. Synergia Energy applied for 2 licenses to complement its Medway CCS hub. E&I have applied for a license for the Hewitt field. We also expect Spirit Energy to have submitted an application for the East Irish Sea, as they've already announced plans to convert their South and North Morecambe gas fields to CCS. Now, we also know the southern North Sea was hotly contested. So on the next slide, I'm going to take a bit of a deeper look at the storage potential in that area. So here we show existing and planned carbon storage licenses, as well as major production pipelines. New proposed CO2 pipelines are shown in yellow, and you can see the 2 pipelines from the Humber and the Teesside region, which form part of the Northern Endurance Partnership that's being proposed. The red dots show the cumulative production for each of the hydrocarbon fields, which can be an indicative or a proxy as potential injection volumes, while potential storage sites in saline aquifers are mapped in the blue and pink crosshatch. So Westwood currently hold 59 hydrocarbon fields that have an expected cessation of production before 2030 in this region. Within the SNS, we also hold 51 Triassic bunter sandstone closures, which have also been mapped. So clearly the area has a high number of potential storage candidates, but that's not the only reason it may have been hotly contested. As well as storage potential, one needs to think about emission sources. The East Coast region of the Teesside and Humber is the largest emitting industrial cluster in the UK, emitting over 15 million tonnes of CO2 per year. The Southern North Sea is also the closest domestic storage to a number of large emitters in London and further in the southeast, while also in close proximity to Europe, another source of potential CO2. Put your sources and your sinks together and factor in potential existing pipeline and infrastructure reuse, and suddenly it starts to become apparent about why this area was so hotly contested. But when it comes to CCS, you also need to think about future CO2 sources. And when it comes to CCS in UK and Norway, you've also got to consider the hydrogen industry. Blue hydrogen might supply you with additional sources of CO2, and yet green hydrogen may actually end up taking this away from you. So on the next slide, I'm going to have a look at how hydrogen projects are developing in relation to the CCS industry. Here we show the proximity of the green and blue hydrogen projects, which we're tracking in new energies in relation to the carbon storage licenses and available areas. Sticking with the same color theme, carbon storage licenses in yellow, available acreage in pink. The map on the right should be fairly familiar to you by now, while on the Norwegian map, you can see the CS licenses, including the 6 ones that have already been awarded and the available acreage. So attention to hydrogen has increased over the last couple of years due to concerns around energy security. Both the UK and Germany have doubled their hydrogen targets from 5 gigawatts to 10, while the Netherlands also wants to double its current target to 8 gigawatts. Looking at the maps, as one would expect, blue hydrogen projects have to balance proximity to consumers with CO2 storage sites, while green hydrogen projects can develop in geographically dispersed areas, at least in the short term. We're also jumping into country specifics. It's interesting to then actually see how the different approaches for each of these countries are taking with hydrogen. So let's start with Norway. With an electricity grid that's nearly entirely renewable, and when over 50% of your national emissions come from the offshore oil and gas industry, Norway's focus can move beyond national decarbonisation and focus on supporting European needs. And their hydrogen strategy is very much focused on exports, be that either as hydrogen or via heavier energy density carriers, such as ammonia. And Europe's reacting accordingly to Norway's drive to become a hydrogen exporter, with European hydrogen importers, particularly Germany, working on building their infrastructure to import and distribute hydrogen to their demand centres. In the UK, the picture's slightly different, with large industrial heartlands and a number of heavy industries that will require fuel switching to hydrogen to help decarbonise. The focus on hydrogen production is very much for internal use for now, with perhaps exports to Europe the longer term future. Blue hydrogen projects are forming the backbone of the 2 Track 1 clusters, with 3 out of the 8 carbon capture projects progressing in Track 1 being hydrogen. In fact, of the initial phases of Track 1, of the 6 million tonnes of CO2 which will be captured across HyNet and East Coast cluster, we estimate that slightly less than a third of this will be coming from blue hydrogen production. But when it comes to hydrogen, and for that matter CCS, the big question is not what's happening here, but what's happening over the pond. Europe faces fierce competition from the US following last year's Inflation Reduction Act. The key question is, to what extent will this draw investment and supply chains away from Europe, or can Europe provide enough incentive to both keep production and demand within its borders? So I've touched on some of the major themes we've seen recently in energy transition space, but there's plenty more happening. We've seen numerous changes of ownership in major projects. BP recently joined Harbour Energy and Viking CCS. Shell and National Grid exited the Northern Endurance Partnership, while Equinor and Vår Energy both left the Barents Blue project. The EU ETS, the European Emission Trading Scheme, which essentially allows markets to dictate the value of CO2, recently hit over €100 per tonne. In the UK, in the spring budget, the government pledged to invest £20 billion over a 20-year period to scale up CCS project. As part of the Track 1 clusters, sequencing process, the first tranche of carbon capture projects was shortlisted from 20 down to 8. We also had further announcements on Track 2. An expression of interest period opened for a month, with Viking CCS and Acorn seen as the likely front runners to be selected. Elsewhere in the UK, business models for carbon capture, transport and storage and hydrogen continue to be finalised, although the hydrogen transport and storage infrastructure business model is not actually expected to be developed until 2025. Norway continues to strengthen energy transition ties with Europe and break down the barriers to CO2 transport. So in April, the EU and Norway established its Green Alliance to strengthen cooperation on the clean energy transition, while Belgium and Norway have started formal negotiations for cross-border transport of CO2. When it comes to CCS in Norway, it's hard not to mention Northern Lights, and the project continues to progress through EPC despite delays to one of its capture sites, the Klemetsrud Waste-to-Energy facility, which is carrying out a cost reduction period. And that's just what's been happening in UK and Norway. There's a huge amount happening across Europe. We're particularly interested in how the hydrogen markets are developing in countries such as Germany and France. While in CCS, we're also monitoring the progress of the industry in the US and Asia, while keeping an eye on those projects closer to home. So to conclude, it's a busy space. It's been a busy year, and we're not even halfway through it. I'm excited to see what brings next over the 6 months.
Thanks, Stuart, and thanks, Ali, for both your presentations. Just a reminder, if you do have any questions, then please use the Q&A button. But before we take any questions, I just wanted to wrap up and pull things all together. As we saw from Stuart's slides, there is a lot of activity in Northwest Europe to support the transition to a net zero economy. At the same time, there is recognition that oil and gas will continue to be part of the energy mix. As Ali outlined in her presentation, there is still appetite for exploration in both the UK and Norway. In 2023, there is the potential for 37 wells in Norway and 12 in the UK, both up on previous years. There also continues to be high interest in oil and gas licensing rounds. How long this activity will be sustained for will largely depend on how quickly low carbon energy sources can be scaled up to support Europe's energy demand. Exploration for hydrocarbons has always come with subsurface and above ground risks, but companies wishing to continue exploration through the transition to net zero emissions face additional challenges. Most companies have emissions targets associated with their operations, as well as having to adhere to more stringent environmental regulations. However, successful exploration can improve a company's emissions targets. Discoveries around existing infrastructure could reduce the emissions intensity of a hub, as well as extend the hub life, while new standalone developments can allow the use of new cleaner technologies. The time taken from exploration to production is a key consideration given the uncertainty about the pace of the energy transition, the drop in demand for hydrocarbons, as well as potential hub closures, particularly in the UK. Most companies in the region are therefore focusing more and more on ILX exploration strategies, which reduces the time to monetize any discoveries. Given the turbulence in the external environment over the last few years, we will undoubtedly see some companies in the region reduce investment in oil and gas activities, or even exit the region. Many companies are and will become more involved in new energy technologies. However, governments and E&P companies do recognise that the oil and gas industry will still be needed to play its role in the transition to a net zero economy for the time being.